Americans fail when it comes to financial literacy. 44% of Americans do not have enough to cover a $400 medical expense. That's not a lot of money considering that the average medical bill runs over $1,000. Now, who's to blame for the financial illiteracy? The government, parents, school systems. Now, I'm not going to point any fingers. I'm a big fan of staying with what's in our control. So today I'm going to be showing you 16 financial concepts, and you can learn them or brush up on them and share them with others. First up, money isn't evil. Now, some people think that money is evil, but that's a misguided belief. What some people can do for money is evil, but that's inherent in any monetary system. Money is simply an intermediate for the exchange of goods and services. It's an unbiased measuring stick that tends to gravitate towards where it's best treated. This is a core financial concept that everyone should know. As a consumer, you want to get the most value per dollar that you spend. And on the other side, businesses want the same. So they will end up paying more for workers when the workers add more value to them. So I hope this new trend catches on. Instead of saying going to work, if you slightly tweak it and say going to add value, it can change the mindset from going to work, clock in, clock out, collect a paycheck, to going to add value. How can you add more value? And in turn, you'll be able to be paid more. Second financial concept, value is relative. Learning how to value what you buy is important, and people value things in different ways. It's very apparent when you're at a market where people are bidding, like an auction, a live auction, but in other markets, it is harder to see. So look past the surface, do your homework, and use history as a guide to help you determine value. When it comes to investing in stocks, I see too many people focused on share price. Although it's more important to focus on the underlying business, because now you're a partial owner as a stockholder. Is the underlying business valuable, or as valuable as your percentage ownership cost you? Here are some wise words from one of the world's best investors, Warren Buffett. Whether socks or stocks, I like buying quality merchandise when it's marked down. Third concept, supply and demand. This is a very basic economic concept, but it's very powerful. When demand outpaces supply, prices tend to rise, and that works in reverse. This concept goes hand in hand with determining anything's value. To better predict where prices are going, you can track supply and demand. This is very apparent in some areas of the economy. For example, financial analysts looking to predict agricultural prices. If they expect really harsh weather in the future, then supply for that agricultural good is going to go down. And if demand stays constant, then you'll expect prices to go up in the future, so investors can buy futures to profit on that trend. Supply and demand, one piece of it can also be used against you, the supply. A lot of marketers will create perceived scarcity. Many companies will use a limited number of products or service available to help create a sense of urgency and get people to spend without thinking as much about it. But you can step back, take a little bit more time to think about the sale or the limited quantity, if it truly isn't a limited quantity. 4, active versus passive income. When you go to work and you collect a wage or income that way, that is considered active income. On the other side, there's passive income. If you put your money and your assets to work for you, they can generate wealth and you don't have to do anything, so that's considered passive income. For example, collecting rental income can be a passive strategy if you're not taking a big active role in managing that real estate. But personally, I'm a bigger fan of dividend investing, investing in blue chip dividend stocks that will continue paying dividends year over year, and with many of them raising their dividends. To retire comfortably, I'm trying to replace my active income with passive income. I'm trying to reach financial independence this way. And it's a steep goal, but I'm hoping to reach that by age 35, financial independence. 5, delayed gratification. Humans have developed to seek short-term gratification in many areas of life. For example, eating fast food. That's why obesity rates are high and debt levels are high. Saving for a rainy day is challenging to do, but it can lower stress down the road if you delay that gratification of not spending today. You can take out debt and buy fancy things, or if you wait and you save up cash, you can get better discounts on some big ticket items like cars and houses. So it really pays to delay some gratification because you'll get more for it down the road. It's a powerful concept, but it's not easy to follow. But once you see the positive effects, it becomes easier to postpone gratification because you'll see the impact of delaying it in the past and how much better of a life you can obtain for doing so. 6. Interest works for or against you. When you take debt out, you end up paying more. To incentivize the lenders, you have to pay them a little bit of interest to temporarily take their money. But the interest rates eat away at your returns and your net worth. It can make sense to take out debt in a few situations, but 95% of the time, it doesn't make sense. Try and avoid debt like the plague. Instead, you can save, lend your money, and collect interest to become wealthy over time. Put your money to work for you. 7. Compound interest. Compound interest is a very powerful concept that impacts you in many areas of life. In a nutshell, it's when you put the interest that you earn on investments back to work for you. Your savings grow at a faster rate the longer you let them grow. For example, if you collected $100,000 at a 5% annual interest rate, you'd collect $5,000 a year in interest. Now, over 10 years, if you took out that $5,000 each year, you would have collected $50,000 in total interest. But instead, if you put that interest back to work for you, instead of a total of $50,000 in interest in 10 years, you would have $62,889, a pretty substantial difference, and that's 10 years. Now compounding over 20 years, the difference is $150,000 versus $332,000, a much wider gap due to the compounding effect. And going a little bit farther, it compounds more. In 50 years, that's $250,000 in simple interest versus about $1,040,000 when you let the interest compound. Compounding, quote often attributed to Albert Einstein, is the 8th wonder of the world. 8. Focus on both reward and risk. People will often tell you about their big winners, but they are not as likely to tell you about their big losers. This skews reality. People focus too much on the potential for big gains and fail to incorporate the risks. But measuring risk is just as important. To measure risk, volatility is widely used. How fast does an asset's price move in the open market? For example, cryptocurrency could be up 10% in a day or down 10% in a day. It's considered a more volatile asset and risky in the short term. On the other hand, most government bonds are lower risk. You're not going to see as big of price fluctuations, and this makes it easier for analysts, financial savvy people to predict future movements. I live in Baltimore and sirens are going. Classic. And generally, the higher the risk, the higher the return. This is a top financial concept, and also it's important to consider that risk changes depending on your time frame. For example, stocks are pretty risky any few years in the short term, but in the long term, if you're seeking a higher return, it's more risky not to be invested in stocks. 9. Lower fees with a passive investing approach. Small fees can really eat away at your returns. 1 or 2% also compounds and works against you. Although most active managers that charge those fees don't outperform a passive approach where you can spend a lot less in fees. On top of that, with the compounding of those fees, 1 or 2% over a lifetime could easily be over $100,000 compounded in fees that you've missed out on. Instead, you can buy low-cost funds such as funds through Vanguard. One of their most popular funds that tracks the S&P 500 is the Vanguard S&P 500 ETF, VOO. It has an expense ratio of 0.03%, and that's near impossible to beat. 10. After-tax returns. Now, Uncle Sam needs his cut to keep the country afloat, but you shouldn't pay any more than you have to. There's a big difference between tax evasion and tax avoidance. Evasion is illegally not paying taxes, and avoidance is using the tax code to pay the lowest amount that you're legally required to do. So I recommended always trying to find ways to save money in taxes. I helped with a program called Volunteer Income Tax Assistance back in college, and I learned firsthand that the tax code is a mess. There's easily over 1 million words in the tax code. Although as an individual, you don't need to know 99% of that. There's a few little steps that you can take to improve your financial situation and lower taxes. Although if you do have a more complex situation, a tax professional can be worth their weight in gold. For individuals, contributing to a 401k, HSA, IRA can save you thousands of dollars in any given year. Use that to your advantage. And also, all income is not created equal. Passive income, like dividend income, can be taxed at a lower rate than active income. 11. Inflation is a hidden tax. For example, in 1950, a new car would have cost you about $1,500, and a new suit about $30, maybe less. But today, a new car can easily cost you over $25,000, and a new suit easily over $100. It's pretty easy to see the impact of inflation over the long term, but a lot of people miss each year it impacts you as well. It slowly chips away at your savings if you hold dollars. Now, it's good to keep some cash on hand for emergencies that pop up, maybe emergency medical expenses, or if you're laid off for a few months, but it's not ideal to keep the majority of your savings in cash. After the Great Depression in the 1930s, a lot of people no longer trusted banks and stuffed cash under their mattresses. But after kind of deflation ended and inflation picked back up again, their wealth dropped each year, or their true wealth or spending power. This is an important financial concept that a lot of people overlook. 12. Opportunity cost. Now, you have limited time and resources, and how you spend them is very important because you have a lot of opportunities, so it's important to take a good look at all the opportunities in front of you. This is very important to building your wealth. To do so, you must look at your short and long-term goals. With those in mind, you can better choose which ones are going to help you, or which opportunities are going to help you achieve those goals. Opportunity cost is the benefit that you miss out on for passing by certain opportunities. 13. Sunk cost bias. Have you ever read halfway through a book, realized it's not very good, kind of worthless, and continued reading it anyways? If so, you've fallen prey to sunk cost bias, or fallacy. Sunk cost occurs when you've spent time or money on something that you can't recover, and then those past efforts keep you around spending more. This occurs in investing when investors throw money at a losing investment or continue throwing money at it. So it's always good to revisit your opportunities in current state and forward looking, and also do not overweight sunk costs. This is a very powerful psychology topic, and I've covered a lot of them in the CFA notes that I completed for the level 3 exam, and I'll leave a link in the comments below. 14. Lifestyle inflation. When people inherit money or get a big raise, they often increase their spending with it. And even worse, some people spend their bonuses before they actually get them. This is lifestyle inflation at work. With more income or more money in hand, your wants become reality. You can go out more, you can buy new toys, but a lot of times that's temporary. When someone gets laid off or works through their savings, they're in for hard financial times. So it's good to, instead of lifting your expenses as quickly as your income, to save a little bit more each year. It'll help lead you to financial independence. Save a little, and it can prevent you from hardships down the road. Financial stress can hurt your relationships and actually lower your health. 15. Emotional intelligence. Emotions can be very useful, but more often than not, they lead to less objectivity and worse decisions and outcomes. That's true for relationships, work negotiations, driving, think road rage, and many other areas of life. Understanding emotions can help you make better decisions, life decisions, and financial decisions in general. When investors trade often, they're more likely to make emotional decisions. This is one reason short-term traders tend to underperform long-term investors. Also, short-term traders tend to underweight the fees that they add up over time. In a few studies, women have been shown to be better investors than men. And I believe the studies covered millions of client accounts, so a large sample size. And what they attributed the outperformance to was less trading in the accounts held by women. That allowed them to trade less on emotion. Simply a buy and hold investing approach can lower emotional decisions and improve your financial performance. 16. Don't put all of your eggs in one basket. Diversification. If you diversify your portfolio, you can improve your risk-adjusted return. Now, some people like to point out a quote from Warren Buffett that's a little counter, but let me explain it to you. Quote, "Diversification is protection against ignorance. It makes little sense if you know what you're doing," end quote. That's true at face value, but you'll see if you look a little further that Warren Buffett accepts this ignorance, accepts that he is ignorant. If you look at his portfolio, he's invested in candy companies, railroads, banks, technology firms, a wide range of companies to diversify. Putting your life savings in one company, one asset, or one sector is too risky. To put it in perspective, a 90% loss, it takes a 900% gain to break even after that loss. That's ridiculous. Diversification can lower downside risk, and I've accepted my ignorance just as Warren Buffett has and other great investors. It might be good if you consider the same. If you take the financial concepts that I've shared with you today and just learn a few of them, put them to work in your life, you'll get to a more financially sound place and just make better life decisions. I'm personally using many of these financial concepts, and my big goal is to reach financial independence by age 35. These concepts are helping me get there faster. Which of these concepts do you use in your life? I'd really love to hear from you. If you have any thoughts, comments, feedback. Also, I'd really appreciate it if you tap the like button down below as well as subscribe to my channel. I have a lot more useful information coming, and I hope you stick with me. Thank you.